This company is trading at $28 per share, but it could be worth closer to $140, implying a potential return of 400%. Versigent is a newly independent company focused on the electrical system inside modern vehicles. From power distribution to data connectivity, it plays a central role in enabling companies like Tesla and BYD to build increasingly complex vehicles. Right now it's trading at $28 per share with a PE ratio of about 4 times, compared to a sector average closer to 20. Despite having stronger margins and a solid balance sheet, the market is still valuing it at a discount, but likely not for long. The key point is this: Versigent is a spin-off, and spin-offs are often temporarily mispriced. In the early days after the separation, many investors sell their shares for reasons unrelated to the company's fundamentals. That can create an opportunity. If the market eventually recognizes its true value, the upside could be significant. First, what is a spin-off? It's when a large company separates one of its divisions into a new independent company that trades on its own in the stock market. In this case, Aptiv spun off Versigent on April 1, 2026. Before the spin-off, Aptiv provided both hardware and software to the automotive industry. Now it's focusing on software, while spinning off its hardware division into Versigent. This kind of separation is common. It allows each business to be more focused and, in many cases, more accurately valued by the market. Now, as an automotive components company, Versigent can operate independently with more flexibility in areas like partnerships, operational structure, and long-term planning. More importantly, it starts with a strong position relative to its peers. Versigent was launched with solid financials. It generates around $9 billion in revenue and about $0.4 billion in net income. That implies a net income margin of roughly 5% and a return on assets close to 8%. Those numbers may not look impressive at first, but within this sector, they're relatively strong, especially for a newly independent company. Compared to competitors with similar market caps, Versigent is entering the market from a solid competitive position. However, this brings us to the first reason why Versigent may appear undervalued: its balance sheet. The company has around $4.6 billion in assets and about $4.7 billion in liabilities. As part of the spin-off, Aptiv assigned roughly $2 billion in additional debt to Versigent, on top of its existing liabilities. Before the separation, Versigent had closer to $2.7 billion in liabilities. Now that number is significantly higher. At first glance, this may seem unfavorable, but this is a common practice in spin-offs. Parent companies often allocate more debt to a new entity, especially when it has a stable cash flow and solid margins. In this case, it may also reflect confidence in Versigent's ability to handle that debt over time. That view is supported by its recent performance. Over the past year, revenue grew by about 6%, while net income increased by around 30%. By comparison, the sector averages are closer to 3% and 5%. So while the balance sheet may look weaker on the surface, it was structured with the expectation that Versigent can generate enough cash flow to support it. With that in mind, that debt alone doesn't fully explain why the stock is trading at around $28 with a PE ratio of just 4 times. A more likely explanation is a typical spin-off sell-off. When a spin-off happens, shareholders of the parent company, in this case Aptiv, receive shares of the new company. But many investors, especially large funds, didn't specifically choose to own Versigent, so they tend to sell those shares immediately. That selling pressure can push the price down in the short term. For Versigent, this appears to be happening now. It started trading at around $30 on April 1st, and shortly after, it declined to about $28, roughly an 8% drop in just a few days. This is a common pattern in spin-offs. The price can be temporarily depressed, not because of fundamentals, but due to technical selling. Over time, as the market reassesses the company on its own merits, the price may adjust closer to its intrinsic value. However, the timing is uncertain. Since Versigent has only recently been spun off, this selling pressure could persist for some time. So, how much could it rise? As I mentioned earlier, the stock is trading at around $28 with a PE ratio of about 4. If it were valued in line with the sector average, closer to 20 times earnings, the share price could approach $140. However, there are important considerations. Versigent operates in a cyclical hardware-focused sector. That means macroeconomic factors, like inflation or rising input costs, can have a direct impact on its earnings. In addition, hardware businesses typically operate with tighter margins. Even though Versigent's margins are stronger than its peers, the market may still be slow to assign it a higher multiple. So while the upside may be there, it's not guaranteed, and it may take time. This highlights an important point. When investing in spin-offs, it's essential to understand both the opportunity and the risks at the company level and the sector level. As for my position, I've already started buying shares of Versigent, and I may add more if the spin-off sell-off continues to push the price down. To sum up, Versigent appears undervalued at a PE ratio of 4. The business shows solid fundamentals, relatively strong margins, good growth, and a balance sheet that should be manageable if cash flow remains stable. From here, it will be more important to watch how the stock behaves over the next few months, and to evaluate its first results as a standalone company. I'll continue to follow this one closely along with other spin-off opportunities. So if you want more content on spin-off stocks, consider liking the video and subscribing. See you in the next one.